How's it going, everyone? This is Jordan, back with another podcast for FinMeUp. This time on a topic that's near and dear to my heart, Ethereum. So in this quick little 10-minute podcast, we're going to discuss what is Ethereum at a very high level, what are its use cases, and what are some of the risks of Ethereum, and then whether or not in the long term I think it's got a nice trajectory. Now, quick disclaimer, I'm not your financial advisor. I do not have a fiduciary duty. Please, this is not investment advice. You need to do your own research. So, that's it. Let's dive in. Ethereum. To understand Ethereum, you have to understand Bitcoin. Now, Bitcoin was created to be a digital cash, a kind of settlement or payment layer for the internet. I'm going to kind of skip over a bit of the Bitcoin understanding. I'm going to assume that most people know what Bitcoin is, and as well as its use cases. However, where Bitcoin falls short, Bitcoin is an excellent store of value. Bitcoin is an excellent transfer mechanism, and it has some really great traits to it. It's incredibly decentralized. The monetary policy within Bitcoin is like really understandably rule-driven. There's a whole bunch of great debates around the proof of work system versus proof of stake, or whether Bitcoin's energy consumption is a good or bad thing. I'm going to brush over all of that stuff for now, because we're going to get to Ethereum. And I think that one of the problems with Ethereum is that people view it as a kind of mini Bitcoin, and that misunderstands it entirely. So where Bitcoin is kind of the Bitcoin protocol, the code that writes Bitcoin, essentially, Bitcoin protocol is there just to create Bitcoins and facilitate the transfer of those Bitcoins between nodes. Nodes are basically just people who have the Bitcoin protocol running on their laptops. I don't want to get too much into Bitcoin, but the problem with Bitcoin is that it's not Turing complete. Whether this is a feature or a bug is up for debate, but the fact that it is not Turing complete means you can't build things on it. It's not a comprehensive platform system thing. It would be so, for instance, Microsoft Word is not Turing complete. You can only do a very, very limited number of things in Microsoft Word. However, Microsoft Excel, because you can kind of construct your own formulas and you can play with it a lot, is Turing complete in a really stretch of the imagination. But it is. You can write a flipping massive range of applications via VBA or Microsoft Excel. With Word, there's not a stuff like you cannot do that. So that is Bitcoin. Bitcoin is the gold of the internet. Bitcoin is the Microsoft Word. It's the kind of the big brand name that everybody thinks of when they think of cryptocurrency. And unfortunately, a lot of people look at Bitcoin and they think like Ethereum is just a mini Bitcoin. It's a Bitcoin earlier on in its life cycle. And this is even something that like legit people in the industry will come up and say, but it's a little bit more than that, Ethereum is a Turing complete language, which means you can write smart contracts on it. Smart contracts are just like apps. Think of apps. Apps are whatever you want to make of them, and smart contracts at this point in the game. I mean, you can write a whole range of things. You can write Ethereum Twitter if you want, there actually is a project like that. It's called BitClout, but you can do flipping stacks of things on Ethereum now that you can't do on Bitcoin. Are there competitors to Ethereum? Are there other Turing complete layer ones? Layer one is kind of the base layer of a cryptocurrency, but that's going to get a little bit complicated, so I'll just hang back on that one a bit. If you want to find out more, I did write an article on this over at Vineyard Holdings, which will be in the link. Will be in the description below. But in a nutshell, there are other layer ones. None of them are as decentralized, and very few of them have, in fact, none of them have the developer base or the user base or the existing platforms that are built on the layer ones to the extent that Ethereum does, or is, in the case of decentralization. So as far as a value transfer protocol goes, Bitcoin is probably, it's a more resilient, more robust value transfer mechanism. Right now, Ethereum is much more than that, and arguably, according to many in Ethereum, and I kind of tend towards this angle a little bit myself, Ethereum, or ETH, which is the the commodity that is used in Ethereum can become as good a store of value and whatnot as Bitcoin. But that's a big can of worms, and so I'm not going to get into that too much. The point of my reference for Bitcoin is just to say that from Bitcoin came Ethereum. Vitalik Buterin, the founder of Ethereum, actually used to be a prolific Bitcoin writer before he came up with the idea for this kind of do anything type of platform. Now, what makes Ethereum? If Ethereum is a place where you can kind of compute things, you can do computation, you can write your apps, you can value transact, you can do a stack of things. What makes it better than other value transactors like Visa or MasterCard, or other compute providers like AWS or CDN or whatever? These are the more nuanced questions when you start looking at Ethereum in its competitive positioning. And we'll get into that in a second as far as real world use cases go. But just to kind of give you an understanding of what Ethereum is, a couple of analogies that I've come across in this before. Let me see if I can find them. So here we go. Ethereum is like a bunch of distributed online vending machines. Vending machines in the sense that with a vending machine, you put something in and something pops out at the bottom. You put your money in and Coke pops out. That is a completely set in stone event that is going to happen. Ethereum is similar. Smart contracts, which I mentioned earlier, are like vending machines in the sense that you can put in your ETH, which is the commodity that is used to transact on the Ethereum blockchain. And if you go and quote unquote invest in Ethereum, what you're doing is you're going to buy ETH. Now, ETH has a really complicated role in the system, but I'll get into that in a moment. So as far as a vending machine goes, smart contracts, you put in your ETH and out pops the thing that the smart contract is set to do. Remember, you can set it to do whatever you want. So it's pretty cool. Another analogy for Ethereum is digital oil or communally owned AWS. It's like AWS, but you get paid and you pay in Amazon stock for using it. Packy McCormack has a great quote, which I did use earlier, which is it's the Microsoft Excel of the blockchain world. It's the TCP of Web 3.0, which is a bit of a more technical one. You have to kind of think about what Web 3.0 is, but if you're interested, you can read the article. And it's like contract law and property law found a Bloomberg terminal. So it's a lot of things. And I imagine that over time, these definitions of Ethereum will start to narrow over time as people realize, okay, maybe it's not so great at that, or maybe it's not so great at that. I remember back in 2017 when Bitcoin came out, everyone was like, oh no, we're going to use Bitcoin to solve the education system. We're going to put the education database on Bitcoin. And, that was because a lot of people in the main kind of bulk of the people who were then hearing about Bitcoin for the first time didn't understand it. They thought that it was just this massive database, which in a sense it is, but it carries a lot of transfer costs. All of crypto carries transfer costs, really, or all of the main ones. And transfer costs are some of the things that hamper Bitcoin and Ethereum. And I'll get to that in a second when I start talking about ETH. But hopefully that's given you a bit of an understanding of what ETH does. For a quick summary, how does Ethereum work? Well, you have these smart contracts that are kind of auto-executing and immutable agreements. And these things underpin the network. Now, devs code these smart contracts using the ETH's programming language, which is called Solidity, and then they send out that code onto a bunch of other computers called nodes, and nodes will get the kind of copy of that code. And whenever a transaction is kind of made between anything, whether it's data or value or whatnot, every single node in the network receives a copy of that transaction and kind of updates the state. The state is kind of the all of the data that exists gets updated to say, yes, this happened. I'm neglecting to mention the whole proof of stake versus proof of work thing because it's a big topic, but not going to dive into it yet. It is in the article quite a bit. But basically every node then updates their copy of the ledger and they say, yes, this is what happened. Now, miners or stakers, proof of stake, proof of work, are validating these transactions that happen, and they're validating kind of the state updates. And as valid blocks are added to the chain, as every transaction happens, added to a block, when you have a full block, a block is added to a chain, and the chain is what is known as the blockchain. That is the history and the current state of all of the transactions in smart contracts. Now, this is a super powerful network of computers. It can do like really whatever you want to do, like I mentioned. But to stop people from overclocking the compute systems here, to stop people from from overloading the network and forcing all of the kind of nodes to just carry stupid amounts of information, users must pay gas fees as kind of computational credits. So whenever I transact on the blockchain, I need to pay a gas fee. Gas is purchased using Ether. So now we're getting quite into the weeds here, but Ether then becomes it's like the oil that you use to, or the petrol that you use to drive your car. It's whenever you drive your car / use the blockchain, you have to pay it in gas. You pay it in petrol or you pay it in Ether. Ether is gas fees. I hope that makes some sense. Now, what happens to gas fees? Well, gas fees get paid currently to the miners, but this is going into the proof of work, proof of stake thing, which I said that I'd avoid. But basically what's happening is, think about ETH in December, hopefully after this, the proof of stake merge. So ETH is going to become proof of stake. And when it does, then all of those gas fees will go to the whole blockchain. The big central, there's not a central body, that's the point of blockchain. But imagine that there's a central body of blockchain, and ETH goes to that central body, and then that central body what's the word I'm looking for? Like allocates all of the ETH that it gets from fees to all of the stakers. So everybody who is staking their ETH then gets a little bit of a yield in that ETH return. It's a little bit more complex. Some of the ETH is burned and others are kind of given to the miners or stakers as yield or incentive to keep mining / staking. Now, that's in a nutshell the role of ETH in the whole system. With Bitcoin, it's a lot more simple. With Bitcoin, you have, whenever a block is mined, like I explained how the blockchain works earlier. Whenever a block is mined, you have a payment of Bitcoin to that block that yields the block. That's it, and the system generates that. So Bitcoin has like a pretty set issuance, and every 10 minutes a block is made, and I think at the moment it's like 6.25 of a Bitcoin gets given to the person who makes that block, and miners all must compete to make these blocks. That's Bitcoin. And what happens is, over time, that amount that gets given to the block like halves, and so you have this what's called the halving cycle. And in the halving cycle, it approaches an asymptote at a point where, like, it just kind of gets to a point where it's not going to yield any more Bitcoin, and then people are just going to get paid in fees. Now, Ethereum there is an issuance, so there are some ETH that are created every time people validate blocks, but for the most part, it's really just fees, or it will be just fees pretty soon. And the issuance rate that there is going to be offset by the burn rate. So part of the fees that you get paid get burned. Now we're really in the weeds. Okay, cool. That's Ethereum in a nutshell. That's how Ethereum works. We've covered the basics. That's really cool. So let's take a step back and say, what can you actually do with ETH? Well, it's complicated again, and I'm gonna try to keep it at a high level. Why Ethereum? Why not Bitcoin? I've kind of explained that Ethereum is programmable. It's ultrasound money is the meme that people use, because of that monetary policy dynamic I described earlier with kind of the burn and the fees. It's pretty sound money, which is the whole use case for Bitcoin, is kind of that it's sound money. Ethereum's transactions are also incredibly fast and cheap relative to Bitcoin. Relative to other cryptocurrencies, it's not so much, but that is partially because when you're trying to increase your transactions, you have to sacrifice decentralization. And Ethereum is kind of the furthest along in optimizing for low cost and high throughput transactions, as well as optimizing for decentralization. Now, ETH is also pretty energy efficient. It's because it's proof of stake. It doesn't use much energy relative to Bitcoin. That is a feature of Bitcoin. It's not a bug, but it is what it is. Now, what can you actually do with Ethereum? So, or before I ask that, why would someone want to do something on Ethereum and not just use like a regular computation thing like AWS, for instance? So the benefit of Ethereum is that it aligns incentives really well, better than traditional software, because everybody owns ETH, because of that dynamic that I explained with ETH being like the oil for your car earlier. It's a fantastic incentive alignment. Now, it's also really tough to attack. You because of the proof of stake model, you have to have a bucket load of money to try and attack ETH and harm the actual network. Now, you can harm the protocols that are built on top of the network, which we've just kind of seen recently with Polygon, I think it was. Maybe it was the Poly network, I don't know. But just recently there was a $600 million fork that happened in one of the DeFi protocols where a hacker kind of stole a bunch of money, but that's a sidebar. You can't really so easily do that with ETH anymore. You used to be able to. A couple of years back, there was something called the Dow Attack, which happened, which was where a whole bunch of money was kind of forked on ETH. And ETH had to make a decision where they decided to refork the protocol backwards. This is... oh, man. I really didn't want to get super deep. It was super technical, so I'm trying to keep this high level. Basically, ETH is hard to attack. It's also got great incentives. That's a great reason for why ETH. It's also got kind of an increasing number of use cases in the sense that you have more what are called dApps, decentralized apps, being built on ETH every day. There's a ridiculously smart, cash flush, innovative community around the Ethereum token or ETH. And I do suggest, if you are interested, start spending some time in the community. Go on Twitter, just chat to people who are quite into Ethereum. Go on Discord, go on Reddit or Telegram or whatnot. These are great places to start to get to know people in the industry. Now, what are the real world applications of Ethereum? Well, the number one is, in terms of like money usage, is what's called DeFi. And DeFi stands for Decentralized Finance. It's basically the creation of an alternative financial system. And this, in the sense that Bitcoin wanted to be like a cash replacement, DeFi wants to replace the entire financial infrastructure. On top of ETH, as a settlement layer and as a computation layer, you have things that are being built called layer 2s and layer 3s and dApps and whatnot. These are, for a lack of a better term, money Legos. That's kind of another meme in the ETH world. And these money Legos are they're ways of replacing kind of standard infrastructure that already exists in the financial world with a decentralized alternative that's kind of trustless, and you don't have to do the KYC, stuff like that. An example of a DeFi protocol would be something like Uniswap, which is like an exchange where you can swap tokens for one another, and you can take out loans. Not necessarily Uniswap, but throughout the entire platform, you can take out loans. You can leverage things. You can buy stocks. I mean, in a way, they're called synthetic assets, but you can buy stocks. You can do whatever you want in a regular world on Ethereum via DeFi. Currently, the problems with DeFi are like it's just got a shoddy UX. It's really complicated to use, and it requires quite a high level of like technical understanding and quite a high risk appetite, because there are still problems that are happening with it. However, one of the use cases for Ethereum is to replace the financial industry, which is insane if you think about it. That's incredibly big. It's incredibly ambitious, and it's coming like a ton of bricks. Like, they've made stupid progress in the last couple of years. Now, another alternative use case for Ethereum is games. There's a game called Axie Infinity, which is probably the most popular blockchain game. It's like stupidly big as well. I think they just did oh man, I don't want to get my figures wrong, but I think it was something like a $1 billion in yearly revenue last year, over the last 12 months, if I recall right. Don't quote me on that. I might be so way off. But on-chain games actually account for roughly like 80% of the total number of transactions made on the ETH system. And games are, why would you want a decentralized game? So a decentralized game has the benefit of being interoperable. This is one of the keywords that you'll see when you start looking into Ethereum, is the interoperability or the composability. It's the ability to kind of integrate with alternative things. Right now, it doesn't seem that big, but it kind of seems a little bit gimmicky and like toy-like. In the long run, imagine you have a World of Warcraft character that you can use on Fortnite, and then he can buy a car in, or you can use your character in Fortnite for FIFA, for instance. That's a interoperability feature that games that are built on the blockchain, because they're kind of generally permissionless and decentralized, can interoperate with each other like that. It's the beginnings of underpinning the metaverse. Now, metaverse is a huge concept, which there's a great VC. His name is Matthew Ball. He's got a fantastic website where he's got a primer on this, which is a 9-part essay of brilliant proportions, where he kind of deep dives into the industry around the metaverse. But without going into that too much, it's like imagine the internet, but instead of looking at it, you are inside of it. Facebook has suddenly come out and been like punting the metaverse idea recently. In their more recent earnings call, Zuck hopped on and just was drowning on about metaverse this, metaverse that, and it's a really big punt coming from the top. Games on the blockchain are one of kind of the few use cases of a metaverse that's really starting to take form that we're seeing. And then the final major use case today is NFTs. NFTs have come and taken the world by storm, and you might be looking at them thinking like, this is completely stupid. Why would somebody pay an absurd amount of money, like well into the millions? I think that the highest price one currently at Thumbsuck, maybe 8-9 million, I don't know, maybe I'm wrong, dollars. It's crazy expensive. And why would somebody pay that for what is essentially like a JPEG? That's a great question. I'm not going to comment on whether or not I think that NFTs are a great investment just yet, but I do think that understanding the tech that underpins an NFT is quite pivotal. It's the scarcity, it's the creation of scarcity around something that was previously not scarce. So where previously you couldn't own a meme, for instance, now you can. You can actually own a meme. You could use NFTs to kind of create these digital ID things where you can start to put unique documents onto the internet and trust that they are unique and not kind of a replica. NFTs have a very wide use case, and Chris Dixon from A16Z has a lot of work on them, so I do recommend going to look into there, but this is already a longer podcast than I thought it would be. NFTs, DeFi, and games are the top 3 use cases for Ethereum right now. The extension of DeFi is that one day it'll be able to do everything the financial system does with as good a UX and at lower cost, far lower cost actually. And the idea of NFTs right now, again, it looks like it's just JPEGs, but in theory, the tech is that it can bring all kinds of certification on-chain, IDs, title deeds, state docs, multi-game digital goods, your skins for like CSGO, whatever, IP protection. That stuff can all come on-chain. And then kind of a third, we mentioned games, a fourth potential use case in the future is IoT, where you need specific registration of like a particular thing. So my phone then already it carries kind of its own unique ID, but this ID can't really interoperate with other things very well. I can't, for instance, verify that my phone okay, actually, you know what, we've gone way off topic there. Let's not talk about that. It is in the essay if you want to go look at it, but for now, this is high level. Got to zoom right back out. We've covered what is Ethereum, what are the real world applications of Ethereum, and let's get to what are some of the risks with Ethereum. So in addition to risks, I'm going to mention scaling. Scaling is not so much a risk as it is a constraint. Right now, Ethereum it's not scaling super well, And if it wants to be a settlement layer, it has to scale fantastically. It has to be able to compete with Visa and MasterCard for payment settlements. It has to be able to compete with AWS for compute. That's a very tall order in all senses. I'm going to try and find the data here somewhere. I know I wrote it down. Yeah. So for instance, at a cost per byte level, AWS is maybe like a thousandth of a cent of dollars. Whereas currently, if you want to send something on Ethereum, it'll cost you a chunk. Like your lowest data cost, your lowest what's called gas fee, it can range anywhere from like half a dollar to $60, and that's really limiting, especially if what you're sending is data and not like these massive funds of transactions. If you're sending $1 million, that's fine. You can pay $60. It's like a negligible percent, much smaller than you'll pay for Visa or MasterCard. But if you're sending a couple bytes across because it's a game that's making a registration, you can't do that on the Ethereum chain. You have to do it via some of the scaling methods. I'm also not going to touch too much on scaling in this podcast. I'm just going to say that it's a constraint, and it is being solved. There are like really smart solutions out there to how you can scale Ethereum. The proof of stake merge that's happening in December, which I mentioned, is one of these. But long story short, it's kind of tough, and there's not that much that you can do very quickly. It's really hard to replicate. So that's the first big drawback with Ethereum, big constraint. Now, a second risk, there's actually lots of risks, to be honest, with Ethereum, but I'm just going to run through them in a nutshell. So there's relatively low switching costs for utility protocols. We saw this when people started, like a lot of the use case for Ethereum and cryptocurrency currently is just moving money around to either earn yield or to avoid KYC AML, or because you're trying to transfer like remittances or something. Now this element of Ethereum is you can do it fairly easily via alternatives like BSC, or even Bitcoin, Lightning and whatnot. There's a lot of other offerings here. Again, I'm not going to speak about why I think the risk is kind of counted or whatnot. I do in the article. Here, this is just a nice little high-level summary. You also get CBDCs, the central bank digital currency. China is currently quite far ahead in producing their digital yuan. It's a big risk to what's competitive risk to Ethereum, in the sense that if you have a digital state-backed currency, that's quite a nice thing to have, and many people might opt to use that instead of the store of value that Ethereum offers. Another competitive threat, most people don't really read code. The unbanked are not going to verify, quote unquote. So like it's a tough time convincing people to use Ethereum if they can't understand the use case from a non-technical perspective, even in this one. And I've tried to give you like a kind of a meaty understanding of Ethereum while keeping it high level. If you're listening to this podcast, you're probably quite interested in cryptocurrency, and you probably want to learn a little bit more. With the majority of people, your mom, for instance, she's just not going to care. So unless Ethereum can really up the UX experience, the kind of the front end things, it's going to be tough, and they're going to have a hard time breaking into that critical mass. Finally, it's possible that decentralization is not worth the cost. So if we jump back quickly to the scaling slide, there we go. It's a high cost currently, and it'll probably always be at a bit of a premium until there's really novel ways of bringing it all the way down to kind of the AWS CDN level of cost per byte or megabyte. Otherwise, Ethereum will always trade at a bit of a premium. And so if devs decide that no, decentralization is not worth the cost of compute, then Ethereum will probably hit a limit at some point. I think it's very far away from that, and currently the amount of demand that we're seeing for decentralized goods is insane. It's way, way bigger than Ethereum can handle, and that's why scaling is such an issue. However, it's possible that at some point the trade-off just won't be worth it for people. Now, some external threats. There have been a lot of kind of criticisms of Ethereum from governments, Ethereum and Bitcoin, kind of cryptocurrency, I'm going to lump it together. And so states can shut down the fiat crypto on-ramp gateway. And they can do a bunch of stuff to kind of hamper the growth and adoption of Ethereum, but this is the biggest one. Basically, at the point where you go and invest, quote unquote, in Ethereum, like you go and buy crypto, you are trading fiat money for crypto money. And the state can come in and say, like, look, no, I'm going to cut that there, because they have generally got good ties over the people who do that swap for you. Now, there are ways around that. If you decentralize completely, it's impossible, and it's like completely P2P. But a lot of the centralized exchanges where most people buy on, the state can definitely come in and like hamper that a bit. There's also kind of the threat of quantum computing, but if I'm honest, we're actually so far away from that. It's wild. And not only are we far away from it, but it's a well-documented issue, or a well-documented prospect within the community. There's like good literature out there that people are quite aware of things that they can do if quantum computing becomes a reality. It's not like the community is just hanging around chilling. Finally, there's also the sovereign risk. It's possible that, say, for instance, if America decides they're going to pump Ethereum, and they love Ethereum, and so America goes completely onto Ethereum, and then China's like, cool, we want to hurt America, or we just want to suck the value from Ethereum, then it's possible that China can come and be like, okay, well, we'll buy up a whole stack of Ethereum. They would have to buy 51% of Ethereum, and they can hard fork the thing and like kind of suck all the value. However, this means that definitionally they have to risk more than they put. They have to risk more than they can gain. So the max that they can gain is kind of 49% of the network. They have to risk 51% of it. Also, to gain 51%, if it's already adopted by like a country like America, I honestly doubt if any sovereign can kind of come up with the kind of cash needed to then buy that much Ethereum. Anyway, some more risks. There's a pitch that I'll get to at the end here as to why I think Ethereum's a decent bet, but that pitch will require liquidity. It requires that there's a lot of Ethereum around to trade. The pitch requires illiquidity, but institutional adoption, which is kind of in the pitch, also requires liquidity. So there's a bit of a catch-22 there. Again, in the article, there are ways around this. The creation of staking derivatives and whatnot can provide liquidity. Actually, it's a beautiful system, but get it really complex. So I do suggest reading the article on that. Finally, there's also property law concerns. Crypto is not tied to property law, and this is kind of a big debate in the legal sphere at the moment. How do we not just regulate crypto, but like what is its place in as a digital asset, and what is the law's place when it's in an entirely unregulated asset? It's a nuanced topic where you own something because you possess it over time, but can you prove the ownership, and what type of ownership is it? It's a bit of a complex debate. Anyway, there's also the fact that DeFi is pretty highly levered. DeFi is a really nitty-gritty, convoluted, interoperable mess right now. I mean, it's not a mess. It's actually really cool, but it's a bit of a mess. And within this mess, there's a lot of leverage. And so it's possible that although a lot of the loans and stuff are over-collateralized, that's kind of how it works, there could be a cascade, and the cascade can have an effect on the rest of DeFi. Now, also, one risk, crypto is super, super volatile. This is generally a feature, not a bug, but because of this volatility, it doesn't necessarily mean it's always going to be a nice smooth ride, and it could mean that there's a flip load of downside over whatever time frame actually. So be cautious around the volatility. Some Ethereum specific risks: you've got a potential delayed rollout with the proof of stake. You've got some risks around the faulty upgrades. Ethereum. There's a great article by a lady called Lynn Alden, and in it she says that Ethereum is basically it's still in alpha phase. I don't know if she says alpha or beta, but like in a nutshell, it's still being developed, and it's live while being developed. It's kind of like you're building a plane while you're flying it, and this means that there's always the potential for faulty additions, bad rollouts, all of these stuff. So if you are buying Ethereum, use it as kind of an incentive for you to understand more about it, and for you to get involved with the community, so that you can kind of understand what are the problems that it's facing in the rollouts and all of that stuff. There's the possibility that the ecosystem, which is adopted, but that doesn't spur the token price, and that is a debatable risk. I personally don't think it's that high. I think the kind of the policy of all the rules around how Ethereum and how ETH is used construe it in such a way that it's kind of the value is going to accrue to ETH. But the smarter people than me do disagree sometimes. There's also the possibility that scaling can fail to reduce fees, or that miners don't pass the merge. I did mention this a little bit with the rollout, but I think the transition from mining to proof of stake is a tough one to understand, firstly, and secondly, the miners, I mean, a lot of the miners are also Ethereum community members, and so they have skin in the game in another sense, but miners are not really incentivized to move to proof of stake. It's a loss of their revenue, so there's possibly quite a bit of pushback from miners. There's always code bug risk, and also it's possible that DeFi fails to gain sufficient adoption. And one thing that I haven't mentioned, but again is in the article, is that the tie between Ethereum's price and, ETH's price and DeFi adoption is quite high, where the staking rate for Ethereum, the yield that you get for staking Ethereum, is kind of like the general interest rate in the broader economy. Everything in DeFi is priced towards that interest rate, and that interest rate is kind of reflexively priced by DeFi. If more people lock up their ETH in DeFi, less people are going to stake. And if DeFi fails to gain adoption, maybe it's just got really shoddy UX and everybody hates it and whatnot, then the staking rate is kind of the dynamic that is supposed to be there is not going to be fulfilled properly, and ETH might have a little bit of a bumpy ride. Whoa, okay, cool. That's the risks and threats around Ethereum. Okay, I realize I've mentioned other concerns. There are other concerns around like a Gini coefficient, or it enables criminality, or token appreciation discourages this use, or does the world really need centralization, or individual sovereignty is antisocial. These are more like kind of ethical concerns. Do yourself a favor, pause the video on this slide, read through these things if you have a problem with them, or alternatively go and read the article. I do discuss them at length. Now, all right, do we think that we should bet on Ethereum? Ooh, again, not financial advice, but I think it makes a lot of sense. The current price is around like 3,000 ETH approximately. I think if you factor for kind of the expected value of the potential growth and a little bit of like the optionality of Ethereum, the potential, not even like actually what it does, but just the potential for it, and then you take its existing ecosystem and you kind of just extrapolate the cost that comes from, the value that comes from that, you get roughly, and the mechanics of this are in the article, but you get roughly a $5,500 valuation for ETH. This is really, I say this very cautioned, because how do you value this? This is an asset that we don't really understand. It's incredibly complex, and there's not been an asset like this before. So the valuation methods for something like this are opportunistic and pretty what's the word I'm looking for? Nascent. Like we are trying to discover how to deal with this kind of an asset. You'll see here my valuation is actually quite a bit lower, of 5,500. It's quite a bit lower than like a lot of other analysts, which gives me confidence that it's conservative at best. Now, getting to, do I think ETH is a good bet? There is this idea that you're going to have a supply squeeze come up with Ethereum because of the burning of some Ethereum, and because of people staking Ethereum, and because of Ethereum being locked in DeFi, and all of these things. I know I haven't touched on all these in depth, but just at a high level, there is a pretty decent chance that the float, which is the amount of Ethereum available, like that's circulating, will decrease quite a bit. And if it does, and if the float decreases, And a lot of people become kind of what's called price inelastic hodlers, where they are not going to sell at almost any price, maybe because their Ethereum is staked or because it's locked in DeFi or whatnot. It creates a structural outflow of Ethereum supply, and that means that the Ethereum that's floating around, any change in that becomes worth quite a bit. It kind of levers the effect of a change in price on, or a change in demand on change in price. If something has a very, very thin float and there's not much of it available, then to give an example, let's say we have 1 million bananas, and one banana is R1, and R1, I've got 50 million, you've got 50 million. It's fairly, like, we're both quite easy to trade that stuff, right? We're fairly comfortable to trade a banana for R1. Now let's say you've got 50 million and you stake all but one of them, so you're not going to sell me any, and I stake all but one of them, so there's only 2 bananas trading in circulation. Then the price of a banana, or my willingness to sell a banana and your willingness to buy a banana or whatever, is going to impact the overall value of the bananas a lot more, just by virtue of the fact that those 2 bananas in circulation are representative of the entire bunch of bananas value, which is quite a wild concept to think about. But that's the difference between like a float in circulation and just a general total number of things. Now, the idea is that ETH's float is going to drastically shrink over time in the next like kind of 6 to 18 months, and there's also, because of the proof of stake shift, going to be a decrease in sell pressure as miners stop mining because it's moving to the proof of stake. Miners normally have to sell the Ethereum that they mine to recoup energy costs. That selling pressure is going to be gone. This work, just by the way, quick little nod of massive appreciation. Squish Chaos, at Squish Chaos on Twitter, came up with a brilliant report on this. I strongly recommend the read. But this little supply squeeze here is quite impactful, as is when you factor for the fact that there is going to be a drop off in sell pressure as well because of the move to proof of stake. You have a nice little setup for a rally over time. I'm not going to comment much more than explaining that dynamic because, again, not financial advice. But do I think that Ethereum is a good bet over the long term? I tend to think so, yes. This is how I would finally value Ethereum, and I think fundamentally it's a fair bet in terms of supply-demand mismatch. It can go much, much higher than this. And at today's current prices, I think you have a bit of a lopsided bet on Ethereum. Now, whenever you value an asset, you have to kind of look at the range of outcomes that could happen. And within that range of outcomes, there's still a broad number of outcomes for Ethereum. And the downside is not negligible. There's a higher probability of downside for Ethereum than for other things. So be very cautious. Make sure you understand. And because of the volatility, if you don't understand, you will sell at the wrong time. Now, please do your own due diligence. Buy Ethereum to learn about it. Don't necessarily just, YOLO all of your money into something that you will get FOMO for on the way up and capitulate for on the way down. That's it. Thank you for listening to me ramble about Ethereum, and I hope that it's been educational and enjoyable. All the best, and stay safe.